If you ask me in 6 months, is gold higher? I do think gold is higher. Now, a lot of people are always asking, okay, well, what's your upside cycle target? Well, where could this go in the interim for upside? And I think to do that, what you do is you use what we like to do in the technical world is you use essentially a parallel channel, right? And we start to look at parallels here. And I would say by end of this year, I would not be shocked to see 3,800. Now, that's not the cycle top, but I think 3,800 is likely your upside parallel trend line of resistance. So I think by year end, 3,800. And then I think you're talking in the next couple years well over 5,000.
Gareth Soloway, professional trader and market strategist, views gold's breakout as a defining moment that signals the market is transitioning into a new phase. The sustained move above the $3,500 level is not simply a technical milestone, but evidence of a broader reallocation, as investors increasingly prioritize tangible assets to safeguard wealth against unrestrained government spending and persistent monetary expansion. While short-term pullbacks remain part of any healthy advance, the fact that former resistance has converted into strong support suggests the foundation for a multi-year uptrend is now in place. The steady process of de-dollarization reinforces this strength. Central banks from Asia to Europe continue to add to their bullion reserves, gradually eroding confidence in the dollar's long-term role as the world's primary reserve currency. Although such transitions unfold over decades, each purchase represents another step away from dollar reliance. Within this context, the prospect of gold advancing toward $5,000 becomes increasingly credible, particularly if even a modest shift of capital from U.S. Treasuries toward precious metals occurs. The combination of technical resilience and global monetary realignment underscores why gold is drawing renewed institutional and retail attention. Silver is beginning to follow a similar trajectory, though its pattern has lagged behind gold's breakout. After years of being constrained within a wedge formation that repeatedly capped rallies, the metal has now cleared this ceiling and is advancing toward the critical $48 to $50 range, which coincides with the historic peaks of 1980 and 2011. This zone will serve as a decisive test. A pause could trigger sideways consolidation, but a successful breakout would likely generate a powerful rally supported by silver's dual role as both a monetary asset and an industrial necessity. With demand tied to renewable energy, electrification, and technology, silver carries the potential for amplified gains, positioning it as a dynamic complement to gold in the evolving investment landscape. Now, we present the clips from Gareth's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
If we go to the chart here, what we can clearly see is that gold has had this big breakout above 3,500, which is what you mentioned was the inflation adjusted all-time high. And I think that's amazing to think about, that the market doesn't necessarily, subconsciously it knows what that level was. And we went right there back in April, and then we went into this what's called long base of consolidation. And then what we've seen is a breakout above it. Now, there's two separate ways to look at this. In the short term, gold has put in what we call a topping tail, which means we should be due for a small pullback, which, by the way, small pullbacks are natural occurrences within markets. It's actually healthy for a chart to pull back, or a commodity in this case to pull back. So this topping tail signals that we'll probably retrace. What is the downside retrace where I would start buying again? At 3,500. Former resistance becomes technical support when you break out and retrace. And let's be clear, we're likely going quite a bit higher on gold from here. And the fact is it's just the basis of the government is going to continue to spend. The Fed is continue to do what they've loved doing for ages at this point, which is printing money essentially and flooding the system in any downturns. And that is going to fuel gold higher, and likely, in all fairness, probably down the line Bitcoin as well.
Are you comfortable calling a bottom for gold? Do you see a very strong support line? 3,000 gold? What would that be if you're comfortable calling one?
That's a great point. So 3,500 right now is the line in the sand that I'm watching, but there is always a chance when you've had something like gold run up as much as it has, you could go a little bit lower. But I will tell you this, there's a beautiful downsloping line and upsloping trend line here. It basically, at this point, I have a hard time believing gold would pull back lower than, let's say, 34 to 3,300. There's just way too much support now in this chart, in this zone, that as long as it holds there, you're buying it, at that pullback level. And that's exactly what I plan to do. So again, yes, in the near term, I'm a little like, again, if you say, well, where do you see gold in the next 2 weeks? I think gold comes down. I think it pulls back, natural occurrence. But if you ask me in 6 months, is gold higher? I do think gold is higher. Now, a lot of people are always asking, okay, well, what's your upside cycle target? Well, where could this go in the interim for upside? And I think to do that, what you do is you use what we like to do in the technical world is you use essentially a parallel channel, right? And we start to look at parallels here. And I would say by end of this year, I would not be shocked to see 3,800. Now, that's not the cycle top, but I think 3,800 is likely your upside parallel trend line of resistance. So I think by year end, 3,800. And then I think you're talking in the next couple years well over 5,000. Goldman is pretty much dead on at this point. I love what you mentioned about, these countries. Poland just announced again 30% of their treasury is going to be gold. I think the important thing is that we're slowly seeing this de-dollarization. And again, when people talk de-dollarization, especially in the crypto markets, they're like, oh, it's going to happen overnight. Reserve currencies, if you look historically, that never happens. It's a longer process, but we're seeing the writing on the wall. China just continues to buy gold. Poland now is going to do a portion. And essentially what they're telling you is that they don't feel comfortable with the power that the U.S. wields because they have to rely so much on the dollar. And so they're slowly diversifying away, which will slowly weaken the dollar over time. And in fact, the dollar chart is telling us exactly that. In fact, yeah, so as a technician of the charts, you always want to look at both sides of a trade, right? Because you can believe you're going to be right in one direction, but if it goes against you, how do you maneuver? And so the bear case on gold is probably a retrace to 3,000. 3,000 would be unbelievably important for it to hold. It's that key psychological number. You don't want to see, if you're a gold bug, if you love gold, if you're invested in gold, you don't want to see a two handle at the beginning of gold. So 3,000 right now, again, that 35, 3,400 is where I'm thinking it'll pull back. If it breaks that, you could see 3,000. That must hold. And I do believe that, again, for me, anything below 3,500, I'm going to start buying gold actively all the way down to 3,000. If it breaks 3,000, I'm going to get a little bit concerned, though. Let's be fair.
And most aggressive bull case?
Most aggressive bull case is probably, you're looking at like 10,000 on gold. I would say that would be a dream come true for me that holds a fair amount of the metal as a long-term investment. And I do think, again, if you look at the scenario where we're now as a country spending $1 trillion just on financing the debt, the interest on the debt, I mean, this is really setting up for what I fear is the 100-year cycle, which would match up with the Great Depression. And again, by no means do I want to scare people by using that term, and it's not on the horizon. But I do think they always say, and this is something I grew up with. My grandmother went through the Great Depression. She taught me a lot. But every generation is supposed to experience something like that. And we've gotten away from it. People think it's just easy times and money can grow on trees, essentially, and the Fed can always save the day. And there's something called a 100-year cycle, and we're just nearing that 1929, 1930 period that would be that 100-year cycle for the Great Depression. And I think gold would be the main avenue, and Bitcoin to some extent. Looking good on silver. I continue to like silver here. You can see you had this beautiful wedge pattern right here. And again, this wedge pattern, look at this trend line, how every time going back to 2023, every time it hit, it pulled back, pulled back, pulled back, pulled back, and then pulled back recently in 2025 twice. And then what it does is it gaps above. It's like, okay, I can't walk through this river because the rushing river will take me away. So let me hop over. Let me take the bridge over. And all of a sudden it breaks out, consolidates. This is a bull flag, and it's beginning to move higher. So this is a breakout on silver. And silver we know has lagged gold. I do think it's in the process of playing catch up. Basically, I'm expecting it to have a small stop at $44 per ounce, but really likely headed to about 48 to 50, which would then, if we go to the bigger time frame, 48 to 50, where does that take us? Back to this high here, 1980 and the 2011 highs. Essentially, that would be called a triple top, and that would be expected to be resistance.
So what level would that be at there?
Yeah, so you basically look to sell it to $48 to $50. So if silver gets to 48 to 50, I would expect it to pull back. Now it could eventually break out, and that's what I would start to watch. And let me just do a quick teaching on this. So if you have silver, right, and silver, let's say, rips up to 48 to 50. Let me get my drawing tool out here. So let's say we rally up here. You then watch, as a technician, you watch to see what it does off of this level. What you want it to do is basically go sideways to lower, which creates a bull flag. It's essentially digesting. Think of a marathon runner who just ran a marathon. They're exhausted. You can't be like, go run another marathon. They're going to be like, no way. I need to refuel. I need to sleep. I need to rest. I need to eat. This is what this is. It's consolidating. It's refueling. And then you get your big move up. What you don't want to see is you don't want to see a sharp reversal. A sharp reversal would be bearish. So as a technician, if let's say we get to 48 to $50 an ounce on silver, I will then begin watching what price does around that level, and that will give me insight into the next likely move. I think what we're going to see here is that silver is going to be seen as obviously the macro, driver of combustion engines, which are now becoming more and more popular again after the EV kind of had its phase. And I still think EVs are in that direction, and they will continue to grow, but not nearly as much as people thought. And so I think you have that aspect to it. But I also think that you're looking at, there's these sovereign funds in these countries that are saying, okay, gold has had this massive run, and just like the dollar, we don't want to just be in one metal. Like, what if something happens and there's a massive find of gold? Let's diversify. And I think, again, what's so interesting here is that these countries are learning from their mistake with accepting the dollar as the major reserve currency, where it gives the US way too much power. They're not comfortable with that. And now they're saying, okay, listen, gold is great, but now let's also have a little of X, Y, and Z metals in our portfolio. And I think that's a great thing. I mean, it's the equivalent of having Bitcoin, but having some Ethereum in your portfolio. Same sort of thing, or Apple and Microsoft and Google, right? We just don't go all in on one thing. And they learned from what they've done with the dollar and the power that the U.S. wielded. I've gone on record for the last few years as saying that we are slowly, it's like a train wreck, a very slow train wreck of countries overspending, running up debt, and eventually the fiat system will collapse. I actually think that the Federal Reserve will be the scapegoat when all this goes through, and I think the Fed will likely be disbanded, and there'll be some new form of a Federal Reserve that's put in place. But the basis of it is that those that have physical metals, that is where the value will be held. And I think that's the key. And it's almost like a societal reset, right? I mean, you see everything going on in the world today, and it's just getting worse and worse and worse, whether it's social media or all these other avenues. And it's going to reach a boiling point. And the U.S., along with all these other countries, they've lived off of debt, and it's unsustainable. And there will be a collapse, and it will be a financial reset. I do think what comes from the ashes of that will be amazingly good, but it's going to be the hardest time, like we talked about earlier, since the Great Depression. It will be the hardest time, hopefully not worse.
Global markets are increasingly bracing for a pivot in monetary policy as central banks signal that rate cuts are on the horizon, a move that historically reflects underlying economic weakness rather than renewed confidence. Investors may initially welcome the idea of cheaper borrowing costs, but seasoned analysts warn that cuts typically arrive when growth momentum has already faded, job markets are softening, and credit strains are rising. This shift alters the investment landscape. Equities can lose their footing as fundamentals deteriorate, while declining yields and currency pressure enhance the appeal of hard assets. The changing policy backdrop underscores that the real story is not about stimulus driving expansion, but about investors seeking stability in the face of late-cycle vulnerabilities. Against this backdrop, gold and silver are emerging as the standout assets to watch. Gold continues to serve as a cornerstone of stability, offering protection against monetary uncertainty and erosion of fiat value, while silver combines that defensive role with strong industrial relevance in sectors such as renewable energy and advanced technology. This dual demand positions silver for potentially sharper gains, particularly as its undervaluation relative to gold draws renewed attention from both institutional and retail investors.
So the projections that I have, anyways, that I've done the number crunching on, it looks like inflation will continue to be in the short term up to see upside. So we're going to see probably in the next few PPI, CPI numbers a little bit of an increase. But as the labor market weakens, and this is what happens generally during pre and into recessionary periods, what we start to see is that it actually has a deflationary impact. And so the inflation that we're seeing from tariffs will eventually be offset by deflation of the consumer struggling more and more as the labor market and the economy weakens. And that will bring us down towards at least 3%, maybe a little bit below 3%. The problem is that a good reason to see inflation coming down, right? Is that the reason we want to see inflation coming down? And then how does the labor market or how does the Federal Reserve react? Do they just start throwing more money at the system? Does the government increase spending? Does it then kickstart inflation? But I do think, again, inflation will slowly come back down, but not for good reasons, but for bad reasons, mainly the labor market and economy weakening. And this is what happens every bull market at the very end, is that you have a disconnect, right? And you could even say this disconnect is with gold. Gold and the S&P very rarely continue to make new all-time highs together for as long as we've seen recently. And that tells you something. Both of those will not continue to make new all-time highs. But going to this other factor is, you're right, past bull markets, just before they end, the data starts to weaken, but there's still this FOMO, this fear of missing out amongst retail investors. And what I look for in the data that tells me and puts me on alert is margin levels, right? We're now at all-time highs on margin, which is people borrowing money to get into the market. All right, we now have people investing in meme craze again. We've seen stocks that are now saying, oh, we bought some Chainlink or we bought some Ethereum, and they go up 3,000% in a day. These are the same things that occur in every cycle. And it's a human psychology trait to where you feel like you're missing out. And at that point, you have to play catch up. And by the way, hedge funds find this the hard way too. If into the end of the quarter, they are not performing like the rest or as the market is, they have to just force money. They force money into the market and they try to play catch up. And so this is something that is a human psychology trait, but it's also an indicator of market tops. And so again, whether we're topping today or whether it's a week or a month away, that's hard to predict. And I'm not a great predictor of that. But what I do know, and I've been through 99, 2000, 2007, through COVID, all of these signals occurred just before, even in 2021, we saw the same thing with Bitcoin, with crypto, and with memes like GameStop and AMC. And so, again, it's more of a breadcrumbs where it's dropping these breadcrumbs, and then it's up to us as investors to start pulling the reins back and being a little bit more cautious. So the first thing is I always look at data. And the first thing is to say, okay, in past periods where the Fed begins to cut rates after, an expansionary period begins to slow down, what does the stock market do? And believe it or not, and this goes contrary to kind of the narratives that have been spun out there on social media and even in mainstream media, when the Fed begins to cut rates, the markets actually start to fall. And so this is very interesting because essentially the markets are forward looking, meaning that we're all buying stocks going into the cut because we're assuming that the cuts will be beneficial. But by the time you get to the actual cut, people have already bought in, they're all in the markets. And now there starts to be this fear of people saying, uh-oh, wait a minute, is the Fed behind the curve? And you're going to hear this more and more now in the coming days is, wait a minute, can the Fed not cut as much as they should because inflation is high? These other Fed officials saying we don't even support 2 rate cuts into year end now, which is what the Fed funds tool is telling us. And so for us as investors, there are ways to protect ourselves. Number one, you can buy puts on the market. With the VIX down below 15 or around 15, buying protection via options is very, very cheap. It does cut into your gains, though. There's no doubt about it, as it all will. Or you can just lighten up. There's no one goes broke taking a profit, and that's something I always tell people. So if you have 1,000 shares of NVIDIA long, what you could do is you take a quarter off the table or a half and let the other half run. Put a break-even stop or a in-the-money trailing stop. There are lots of ways to protect yourselves. For me, I'm a little bit more aggressive, so I'm shorting the market into this. I'm looking to get that downside benefit. But again, if you're dead on being long, at least protect yourself.
Looking ahead, the expected shift in monetary direction is likely to reshape how investors allocate capital, with precious metals positioned to gain renewed traction. As borrowing costs move lower in response to slowing activity, confidence in conventional assets could erode, driving a stronger preference for holdings that are not tied to policy decisions or currency dilution. In this climate, the traditional refuge of gold is set to attract heightened demand, offering a shield against both market turbulence and weakening purchasing power. Gareth even projects that, under these conditions, gold could ultimately push toward the $5,000 mark, reflecting its growing role as the ultimate safe haven when trust in financial stability begins to fracture. Silver, meanwhile, could experience an even more dynamic response. Beyond its role as a financial hedge, its connection to clean energy technologies and electronic manufacturing provides a structural engine of demand that persists regardless of economic cycles. When combined with its tendency to outpace gold during periods of inflows, silver stands to benefit disproportionately if investors rotate into tangible assets. The interplay of speculative interest and industrial consumption creates conditions for amplified movements, positioning silver as a potential outperformer in the next phase of the cycle. Drop your thoughts on Gareth's analysis in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.